the Phone, India's only show on corporate law, tax and audit matters.
Our top story this week: India and the US signed an inter-governmental agreement to implement FATCA. Enacted by the US in 2010, the Foreign Account Tax Compliance Act targets tax non-compliance by US taxpayers with foreign accounts. Now, it requires US taxpayers to report certain foreign financial accounts and offshore assets. But more importantly, it also requires foreign financial institutions, say Indian banks, insurance companies, mutual funds, to report financial accounts held by US taxpayers or foreign entities in which US taxpayers hold a substantial ownership interest. Non-compliance by foreign financial institutions could result in the US withholding up to 30% of certain payments. The just-signed inter-governmental agreement simplifies the burden on Indian financial institutions by in fact transferring it to the government, and thus spares them the withholding tax scare. But now that it's been signed, a series of deadlines become applicable, raising the question: is India ready for FATCA? To answer that, I'm joined today by S. Ranganathan, CFO and President of the Edelweiss Group, and EY's Basant Shroff. Gentlemen, to both of you, a warm welcome.
Thank you.
Basant, quickly first, the reporting requirements for foreign financial institutions, say an Indian bank, an Indian mutual fund, or even Edelweiss.
From a reporting requirements perspective, well, if I look at the FATCA documentation, it requires certain amount of reports to be out there by 30th of September 2015.
Okay.
For the financial year ended 31st December 2014.
So what information are they looking for?
They're looking for information for people who are US persons and the income that they're generating out of India from Indian financial institutions. So for example, if somebody is repatriating funds in India, not reporting the income out of that to the US authorities, and so on and so forth. So that's the primary reporting requirement that will come applicable
for Indian financial institutions or foreign financial institutions from the FATCA point of view.
Correct.
Right? And just to clarify, this 30th September deadline that you keep referring to, this is the deadline that's put in the FATCA timelines by the US. This is the date by which all FFIs in Model 1 IGA jurisdictions, that's the kind of IGA India has signed, so all FFIs in India will have to submit the information to the Indian government, who will in turn have to submit it to the US government by September 30th.
Absolutely. So that's the FATCA timelines overall. Now, if India, in the course of action of signing the IGA, would have agreed any other modalities, either in terms of a deferred date or some kind of exclusion for the current 30th September, it's something that is still not known clearly in public.
Okay. How are you dealing with this, Mr. Ranganathan? You have to collect information from your pre-existing clients to find out whether they're US persons or not. You have to collect information from the new clients that you sign up, okay? And you have to report all of this to the Indian government.
Yeah.
How much information do you need? How easy is it to get? And by when do you have to report it to the Indian government?
Is it required to be done? Yes. Otherwise, or for that matter, any of the financial institutions would get covered, which primarily deal with a depository or a custodian or a bank or an insurance company would get squarely covered by this. And there is a reporting requirement, as Basant was talking about. 30th September is the date when we are required, when the Indian government has agreed to exchange this information with the US IRS. But I guess when you look back at the draft rules, which we talked about, 1.4F and 1.4H. The reporting dates were sort of 31st of July, if I recall. Of this year, yeah. That's the first time.
Which meant that financial institutions had to provide the information to the Indian government by 31st of July, and in turn will provide it to the US government or IRS by 30th September. Okay.
So which also means that we are just 15-20 days away from that deadline today.
But those were draft rules, and they were never really made into any final rules.
They haven't been made final even today. So I guess 31st July may not be the due date for
it
the
seems
FFI.
unlikely.
It's coming back to KYC documentation. Yes. Is it going to be a tough thing? Yes, at least to begin with, because the kind of information and the data that we are required to capture for US for any kind of individual is something like 34 points that we are required to submit. For non-individuals, it's about 30, and quite a few of them are mandatory fields that we need to capture. And the schema.
But I saw that FATCA only requires you to obtain information from those people who are US persons, and US persons is sort of very tightly defined, right? A citizen or a resident of the US, a partnership, corporation, estate, etc., incorporated in the US, a non-US incorporated entity but having a 10% shareholding.
These are the definitions which are prescribed, and they are very crisply worded for once.
Right.
This piece of legislation is really very good and effective. But then what you will have to also look at is you will have to collect this data from each of the customers to make sure that whether they qualify or not.
So you have to ask every customer of yours, just like HDFC Bank will have to ask every customer of its, are you a US person or not?
Absolutely.
Is that the only question you ask?
No. What you do is, in a KYC document, you ask a couple of questions or 3 questions. You make it very simple for the customers in India. Ask them 4 or 5 questions. And what happens is, if the answer to that is affirmative, then you start a second round of KYC documentation, which will ask for all these 34 information, or maybe much more than that, what is required to be submitted to CBDT. So that's how you go about.
Just to add to that, I think the way the rules are drafted is there would be a different requirement for the pre-existing customers, because all of the entities that we're talking about, or the FFIs, the Indian FFIs, they have existing customer base.
Okay.
So they will have to do a retrospective effect of KYC, but in order to make the process easier, what the FATCA guidelines have suggested is you do electronic search for individuals where the balances are up to $50,000 US.
So if I was to just try and convert that into an illustration, let's take State Bank of India for that matter, right? A large amount or large number of its depositors may be people who don't have $50,000 of deposits in their accounts,
Absolutely.
right? They would not need to fill out any form. SBI does not need to reach out to them for any additional KYC.
Correct.
That's what you're indicating, right? The same would apply to you, Mr. Ranganathan?
Absolutely right. You need to make sure that you have done your best in terms of capturing of data, in terms of the library that you have created for yourself, and the onward submission of these data that you have collected to the revenue authorities.
But that would be a very small percentage of customers that will have a deposit of $50,000 and more, right?
When I report the number of customers, the number of clients that would go will be very limited in number, which is what my
guess is. Do you have to do
is.
KYC only with those who have, let's say, a deposit of $50,000 and more?
No, if it's a high value, high volume thing, I'll need to do the paper search also to make sure that I have looked at all the entire database of mine to capture the right kind of people, the right kind of reportable entities, and then report that. But eventually, what will go out to the CBDT will be a very small number when compared to the database that I have.
So let me just add to what Mr. Ranganathan said here. So what we're talking about is 2 sets of KYC requirements. One set is for new customers who will onboard as on an effective date, which is still not clear because we're just waiting for the guidelines to come out.
And the timelines.
Yeah, the timelines to come out. Yeah. So after that effective date, every customer will have to go through a new set of KYC requirements, which will require the FFIs to ask pertinent questions around US persons. Now, in order to deal with the customers who are pre-existing as of the cutoff date, whichever is decided, they've created buckets. So if your customer is up to $50,000 account balance, you don't need to do anything. Between 50,000 account balance to 1 million, you are doing a electronic search and then making sure that any information that you already have in your systems which indicate they are US persons, then you need to do additional KYC, an additional requirement.
And ask them the question and maybe put those 30 questions to them.
Absolutely. For accounts which have got $1 million and above, a full due diligence will be required. So you have to ask irrespective of whether you have that information or not.
Well, luckily most of us will fall into the first bucket.
Potentially.
So the compliance work at the end of the FFI is maybe not as daunting as it seems at first.
Exactly.
Right?
Exactly. Having said that, there are specific nuances depending on which industry you belong to. So for example, if I look at insurance companies, what do I ascribe as the cash value of an account?
Okay.
So there are those definitions, and again, if I look at where
well, whatever you do, it's not going to amount to $50,000. I mean, that's a fairly large amount in this day and age, right?
Individuals may not get covered, but I doubt if entity, corporates and all might get covered.
Have you been able to identify what percentage of your client base actually falls in the second bucket, which is they have, you know, the equivalent of $50,000 and more, and therefore you need to at least ask them the question, are you a US person? And if they say yes or they're ambivalent, then you need to ask them an additional 30 questions.
We have a sizable amount of broking clients with us.
Okay.
Now the question is whether the broking clients will get covered or not. The reason for that is these broking clients who might have some other bankers or custodians. Now the custodian will also report these, and we will be just an execution broker. So to that extent, whether we will get covered or not is a question.
How easy is it to get the information from your customers?
Well, it may not be very easy. It may not be very easy. There's going to be a challenge, and but what I have found in all kinds of Indian regulations is as we go along, people do grapple with these issues and the challenges. We overcome the challenges, and the quality of compliance does improve or goes up as with every passing reporting date. Now, having said that, yes, it's very stringent, the consequence of stringent, and it will be very sad to see you close an account just because the KYC documents are not in place.
If your customer does not share the information with you or lies, says I'm not a US person but is a US person, right? Whose liability is it? The customers, the foreign financial institutions, which is the Indian financial institution, or is it the Indian government? Because actually this is not an agreement with the FFI and the US or the IRS, but it's an agreement between the Indian government and the US government.
So the first responsibility, accountability will be the customer.
Okay.
And it will be the FFIs or Indian FI to prove that they asked the question and they got the answer in negative.
Okay.
But if they cannot demonstrate that they asked the question and the customer actually provided misleading information, then that's where the gray zone starts as to who will be accountable.
So it's a shared liability.
It could be a shared in that case. So as a result, documentation of what you have asked, how you've collected the information, and how you've recorded and kept the audit trail around it will become extremely important when you are doing your KYCs.
What are the consequences if you are an individual who has been found to be lying, or if you are an FFI who has been found not to be doing enough due diligence? You know, if you read through the FATCA fine print on the IRS website, essentially the main threat is 30% withholding, right, of certain payments. But this is an inter-governmental agreement. This is not the IRS dealing with Edelweiss or ICICI Bank or HDFC Bank directly.
Correct.
So what would the consequence be?
So in the Indian context, given that we have signed the Model 1 IGA, the consequence at the account holder could be that they might be barred in certain foreign financial institutions on one side. On the other side, their accounts would be reported to the US IRS, and the US IRS, given that they might have a US person status or a US tax residency status, depending on what the facts of the case could be, then accordingly they would be kind of trialed under the US tax regulations and things like that.
Do you expect any regulations around the Indian government penalizing the SSC in that sense, just because he has not done enough, or whatever he has done is irregular, or?
So that's an interesting question, Mr. Ranganathan, but if I look at the draft guidelines that you referred to, most of my read does not give me a sense that the CBDT or any other Indian competent authority would go down to the account holder level yet.
Because what happens is it will get and pass on information to IRS, the information that it receives from the FFIs. If that is sort of corrupted and it's incorrect, then what it passes on is a data which is incorrect. So therefore, it has a responsibility. The Indian government, the CBDT, has a responsibility to make sure that it's authentic information that they get.
So if I was to sort of itemize the challenge list, you know, for financial institutions, firstly you need clarity on the reporting timelines.
That's right.
So you need the Indian government to tell you, Edelweiss, this is the date by which I need the information on all your customers.
And
right?
What information?
So then you need the formats. And the third important thing that you need is for the CBDT to clarify if there are any consequences under Indian law if you are not found to be compliant with FATCA.
That's right.
Have I understood that correctly?
Yeah,
these are the top 3 challenges?
Absolutely.
How concerned are you that we have an inter-governmental agreement that got signed this week? We have potentially a September 30th deadline. We are in the middle of July, and we as yet don't have any of these things, which is the timelines, the final formats, and clarity on the legal consequences.
So if I look at from a Indian FFI perspective, I think they are very concerned at this point in time. So how do we, they're waiting anxiously, saying what the final guidelines would say, particularly from a timeline standpoint, because that becomes extremely critical.
All right, Mr. Ranganathan, I wish you all the best, and I hope you make that September 30th deadline. To both of you, thank you very much for joining us on The Firm.